Welcome to the Times of Industry show. Today I'm speaking with Gary Shilling, whose popular monthly Insight newsletter provides a very well-researched, comprehensive 30 to 40 page report that includes extensive overviews of the economy, investigations into key investment portfolio, how things can impact with regards to economic indicators, and you can get immediate access to Gary's detailed examinations of emerging business opportunity and everything like that. You can call toll free to their office at 1-888-346-7444 or visit them at garyshilling.com. Gary, thank you very much for joining us.
Delighted to be with you.
I'd like to ask you first, I've read the November issue of your Insight newsletter, and I want to ask you, first of all, about the FANGs and the weakness in the FANGs, because you have some research regarding how that can cause the S&P 500 to fall by 30 to 40%. So can you talk a little bit about that?
Well, it's really the question about the virus, and of course it's now spreading like wildfire, and the effects on the economy, and it's really a tug of war between the hope that we're going to see a lot more monetary and fiscal stimuli. Well, the Fed has done about all they can, but a big new fiscal package to support the economy is between that and the effects of the virus and forcing more close downs or certain restrictions in terms of schools and businesses and so on and so forth. And I continue to believe that we're probably going to see a lot more weakness in the economy, that the recession will stretch into next year, and that this is not in all anticipated by the strength we've seen in stocks.
Understood. I do want to ask you this, though, as a follow-up question. So the first COVID had the shock factor, and in 16 days, S&P 500 down 35%. I understand that. Nobody understood what this thing is all about, et cetera, et cetera. Why do you think it will have a similar response this time? 30 to 40% is quite a lot. I can tell you personally, if the S&P 500 goes down by 10%, I'm going to be buying 20%. I'm going to be really buying, et cetera. So 30 to 40% is amazing for a long-term buyer. Do you think that is a possibility that's likely, or are you saying, hey, this could happen, but not likely? More likely is a 10%, 50%, because there's a lot of demand for the S&P at minus 10, minus 15 already.
Well, we'll see. But one of the things about bear markets is that all the way down, the bulls think that it's all over and they want to buy, they want to buy, they want to buy. You only get a good bottom in a bear market when the last bull has thrown in the towel. You've run out of potential sellers and you're left with nothing but potential buyers. But we're certainly not there now, because everybody believes that, as just you said, that if we have any dip, it's a great buying opportunity. I think this is more of a selling opportunity. But going back to your point about what's the difference between now and earlier this year it was a shock. You're absolutely right. But now the question is, what are the effects on the economy? Because the economy and the stock market are not totally unrelated. Now, you do have this other factors I mentioned earlier about what happens in Washington. But, in terms of big new life support fiscal packages, enough to offset what looks like a lot more weakness because of the virus, I just don't think that's going to happen. You're probably going to end up with a divided Congress. It looks like the Republicans will control the Senate. They've gained in the House. You've got a president who is, he's not entirely decisive. So I don't think you're going to see strong responses in Washington, certainly in terms of a big new fiscal package. The administration's got a lot of pressure on them for other things, the environment, their attempts to raise taxes, redistribute income, a lot of other things that can conflict with this whole issue. So I just don't see that there's going to be the kind of massive additional fiscal stimulus that's going to offset the continued effects of the weakness because of the virus.
Okay. Well, it's very interesting because obviously Biden and McConnell in the past they've done deals together in their in all of their years in politics. Biden, you have him yesterday talking about a $3.4 trillion program, whereas the Republicans are looking for doing this very targeted and no direct checks and whatnot. I want to ask you next because we can go on this for forever, I think. In regard to to COVID, you mentioned that in Insight in November, you mentioned that the hopes of a quick and effective vaccine are fading, and yet the stock market remains near all-time highs on the heels of allegedly a positive vaccine results from Moderna and from Pfizer. You have Sputnik from Russia and whatnot. There's a lot of things in the word. Given all of this, what is realistic for like a recovery? Because my thought is 2022 is the real recovery. 2021, you're gonna have so many things happening with regards to, yes, I want the vaccine, no, I don't want to take it, therapeutics, etc., etc. Yeah. There's so much into it, and we don't even know what type of vaccine that is. Is it sterilizing? Is it what's the durability? Do you need a booster? How many? It's just there's a lot of into it. Sorry, sir. Go ahead.
Well, the vaccine development certainly is nothing new on the horizon. I mean, if you go back a month, it wasn't clear that either of these were going to happen anytime soon. Now it does look like the vaccines are being developed and they look like they are effective. It's going to take time, of course, to roll them out, to distribute them, to get people inoculated, and most important, to get people to trust in them, that people say, yeah, I feel safe to go out. And I think that is going to take well into next year. Now, then the question becomes, and so, I think that eventually this is going to aid the economy. But the question is the softness in the meanwhile and the effects of close on, the virus spreading now in double-digit numbers in many states. This isn't going to go away immediately, and of course the question is, how long is it going to take for all of these things to get rolled out? Now, markets anticipate, no question of that, and stocks have been anticipating first a big new round of stimulus. I think that's less likely the kind of thing that Biden wants, with probably the Republicans remaining control of the Senate, and they made big gains in the House. And the House, a lot of the representatives, the Democrats, were being accused of being socialists. Nancy Pelosi is probably on the way out. So you have a different tenor here, and I think it's one less likely to see big action. But again, the question is, how far are markets going to anticipate? If you want to talk about 1922, as you mentioned, or 23, yeah, I think there's every reason to think the economy will be righted. Although, as we saw, even from the effects of the Great Recession and the financial crisis, these things don't go away in a year ago. They have lasting effects. But again, markets typically don't discount things 2 or 3 years down the road.
Yeah. By the way, I said 2022, not 1922, but I think everybody understands what you mentioned. I think, Gary, you've suggested that due to COVID, politicians no longer trust free markets, which is a very interesting remark. Instead, they'll continue to use stimulus and bailouts, and obviously with Democrats likely in control here, large-scale income sort of redistribution, if you want to call it that. What impact will that have on stocks and commodities, in your opinion? Because there's views here and there. Like literally, there's some people that think that's kind of bullish to have MMT and whatnot. Obviously, if people didn't think that, then it wouldn't be on the table. And then obviously you have the conservatives, the Austrians, etc., that say, "Oh, this is madness.
Well, there's
Money
no
are we
question.
spending here?"
Yeah, there's no question that the role of government has changed in the last 100 years. If you go back before the Great Depression in the early 30s, basically the assumption was that the government was there for minimal involvement in the economy. The virtual collapse of the economy in the 1930s and the bringing in of the New Deal, it really changed the whole tenor of things, where government became much more responsible for the health of the economy. It wasn't reliance primarily on the private sector. Now the question is, where do we stand now? The reality with every crisis, you get increased government involvement in the economy. That just seems to follow us the night to day. We saw that again in the 1930s. We've seen it in World War II. Big events like that. We saw it with the financial crisis and governments bailing and the Fed bailing out the banks and so on. And we're getting increased government involvement now. But the question is that enough right now to offset the effects of the virus in the next incoming quarters? But I think there's probably no question in the longer run you have competing developments here. One is you probably do have more lasting government involvement in the economy, but on the other side you have people being much more cautious, and that's again historically the case. We saw that, say, after the financial crisis in 08, where people were very slow to come back to big spending. They were saving more money. They've been saving a lot now. I rather suspect they're going to use that to rebuild assets. A lot of people who, when the virus struck, they found they didn't have any financial reserves, and despite all the government programs and the extra unemployment insurance, they were really pressed. So it's probably going to change their habits with some lasting effects.
Yeah, no, it was a wake up call for sure, because it was literally out of the blue. In response to enthusiastic investors and everything we've seen in 2020, like U.S. listed IPOs that raised $95 billion this year through late September, and then surpassing the total for every year since 2000, since the tech bubble, actually, except for 2014. We also witnessed specs, which I'm sure everyone knows, the special purpose acquisition companies, which are similar to IPOs, where it seems like the millennials are in. Everyone thought, man, this generation is
when you go back to the South Sea bubble in the 1700s, one of the great examples of the same thing, of the special purpose company, investment companies. These are basically, you give me the money and we won't tell you what we're going to do with it. But there was a famous example there of some guy back in the South Sea bubble days who set up shop, and he said he had a great investment scheme, but nobody was to know what it was. Well, he opened shop at 9 o'clock, took in all kinds of money, departed from England, from the continent, at 4 o'clock, never to be seen again, and everybody lost everything. I mean, it's a question of how much risk you want to take. But clearly, with low interest rates, people have moved out on the risk curve. They've moved to junk securities. They've moved to these kinds of special purpose companies with no clear stated goal as to what they're going to. It kind of reminds you of back in the dot-com era, the Socks the Puppet era, where there was money raised, even just on a business plan, no business, no revenue, certainly no profits. But it has a speculative flavor that is not, in the long run, very healthy.
You've written that no one rings the bell when a speculation peaks, but there sometimes are warning signs. Obviously, we're in a big move up. Back in 2007, you mentioned that there was a nosedive in BBB minus and in the subprime mortgage securitization prices. What to you says, hey, this bull market has been going on? Let's, if we leave March out. This bull market has been going on since March of 2009. So even if we add this thing, the markets are at all-time highs. They look to be very richly valued. Obviously, we're in a recovery. You have so much going on. What to you says, hey, now is the time to start thinking more about where are the gains, where are my gains that I've made in the last few years? How can I protect some of them? How can I rethink my portfolio? Maybe I can make the same amount of money with less risk involved. I can take cash out because this thing's moving like very fast. This is something I've done in the last few weeks. I've taken money out and I'm making the same amount of money. It's unbelievable. So what do you think, Gary? What do you will say?
You're quite correct. Nobody rings the bell at speculative peaks, but there are signs. The thing about speculations is that they go far further than is logically, and that's what. And so there's no limit to that thing. But there are sorts of things when you see extreme speculative situations like we have now in a number of areas. One of the interesting ones is what's happening to insider sales and purchases of stocks. Now, normally there are more insider sales than purchases. This is because people get stock options and then they sell them on the open market. This is what happens on the open market. Normally that ratio is about 20 to 1. It's shot up. It's 58 to 1. It's at all-time high. It suggests that insiders are unloading stocks. Now, do these people know a lot more than the public that has been buying stocks? Maybe yes, maybe no. But there is a history when you see this extreme with insiders unloading stocks that you are near a peak in stock markets. This is a very interesting statistic.
So just to clarify for people, 58 to 1, you mean for every 58 shares that they sell, that insiders in general, reporting insiders sell, they buy 1 share.
Yes, this is on the open market. You see, they're getting a lot of those shares through stock options and so on.
Yeah, but just to clarify, this is not every company experiences this 58 to 1, but in general, there's a theme.
This is the average.
Yes.
This is the average.
Yeah. And I want to ask you, unlike some other guests that I've had on, you've recommended long positions in the US dollar and in treasuries, specifically 30-year duration. Why do you think that this is something that is effective?
Well, I've been as you may know, I've been a fan of long treasuries since 1981. Back then, I said in print, we're entering the bond rally of a lifetime. The yield on the 30-year treasury.
That's amazing.
The 30-year treasury was 14.6%.
Yes.
You know where it is now? It's 1.6%. Now, what's happened in the meanwhile? Well, most people don't seem to understand this, but as the yields have gone down, the prices have gone up. And as a result, since then, if you look at what's happened to treasury bonds on a total return basis, most of it appreciation, some of it coupon, they have outperformed the S&P by 5.5 times, 5.5 times. That's because of this appreciation. A lot of people say, well, why would you buy a long treasury? Why would you sell at 1.6%? I couldn't care less what the yield is as long as it's going down. Because if it's going down, the price is going up. It's the same reason most people buy stocks. Most people don't buy stocks for dividend. They buy them for, they hope for appreciation. And it's the same argument. Now, what's the rationale for yields on 30-year treasuries going lower? It's basically that we're in an era of disinflation. We're seeing very low and declining inflation rates. We're seeing a sluggish economy worldwide. Even in China, they have recovered somewhat from the virus, but they're having trouble to generate fast growth. They no longer can do it with exports. They're trying to do it internally. They've got a lot of issues to deal with. We're in a slow growth era, and we're in an excess supply era. If you look at what happened, Asia they're big producers, but they're not big consumers. So there's a savings glut. In other words, the difference between what they produce and what they spend is what they save. And that means that on a global basis, you got more supply than demand. When you have more supply than demand, what happens? Prices go down. And if you look at the long run, and over the entire post-war period, we've studied this in detail, there is a 60% correlation between consumer price inflation year over year and treasury bond yields. In other words, the key to treasury bond yields, despite everything else happens in the economy, political movements, administration change, the real key is inflation. And if we're right that inflation is now going even lower, maybe even negative as it has been in some months, then I think we could see further decline. Now, if we had another 100 basis point decline in 30-year treasuries, you'd see a return of 20%, which I think relative to what you've got in prospects for stocks is very attractive.
Understood. And obviously, you've been very right. 1980, this has been the longest bull market for bonds in recorded history. Last question. You've even recommended shorting the markets either here or abroad. What are, in your opinion, the best ways to actually hedge the stock market? Let's say I'm very long on the stock market. I have a ton of money, in theory, in the stock market. I have a lot riding on a bull market, etc. But I think, hey, maybe Gary's right. Maybe this is going to go down by 30 to 40%. But I'm 36. I have time. Even if it goes down, I'll just buy some more. But I want to protect some of this purchasing power, this equity, I should say. What are some of the best ways you think are out there to hedge the risk of a melt?
We are registered investment advisors, as you may know. We do manage other people's money, and the reason that we have a very small short on the S&P 500, and we're macro oriented, we're top down, we're not stock pickers, but we do have a very small short on the S&P because I want to have a toehold. If things start to move in our direction, I don't want to have to chase it. I've been in this business long enough to know that if things start to move violently in your direction and you don't have any position, then the risk is that you panic in and you make mistakes. So our idea is to have a very, very tiny short position in the S&P. Our primary positions are long treasuries, which have, say, worked great for 40 years. And we also have a small long position in the dollar. Again, the dollar hasn't been a great winner, but if we're right that we see further weakness and a run to treasuries, you got to go through the dollar to get to treasuries if you're a foreigner. So those are the sorts of things that we're interested in portfolios that we manage.
Interesting. Gary, can you tell people, it's GaryShilling.com. How can people get in touch? Do you have anything special to offer to anyone that's listening right now?
Well, they can visit our website, GaryShilling.com, or they can call our toll-free number. You've got it there. What's the toll-free number?
It's 888-346-7444.
Thanks. I'm glad you've got it. Okay. No, we'd be delighted, and if somebody's interested in our services, our investment advisory services, fine. If they'd like to subscribe to our newsletter, we'd be happy to send them a complimentary copy. We can email it to them, and hope it will be helpful to people as investors as they look ahead.
Gary, thank you very much. This has been really nice chatting with you again. I think we haven't done this in like a year and a half, maybe even two, and we'll definitely chat after inauguration. Let's see who's the president, and then we can chat.
Okay, thank you. Look forward to it.
Thank you, Gary.
Bye.